In July of 2024, NASDAQ filed a rule change. It was 47 pages long. It was approved quietly, with almost no press coverage. And what it did was remove one of the last meaningful gatekeeping mechanisms between a company going public and that company immediately entering your index fund.
After this rule, under certain conditions, a company can list on a Monday and be eligible for S&P 500 index inclusion by the following week.
There is one company, one specific company, that benefits from this change more than any other on Earth, and the timing isn't a coincidence. Here is what the financial press will tell you about the SpaceX IPO. SpaceX is the most successful private aerospace company in history. It has a real product, real revenue, real market share. Starlink is now the dominant global satellite internet provider with over 4 million subscribers and growing. The rocket business is profitable on a per-launch basis. The company has a government contract moat that would take a decade to replicate. The IPO, whenever it happens, is going to be one of the largest in history, possibly the largest. The rocket business is profitable on a per-launch basis. And that's appropriate, because this is a serious company with serious fundamentals. The NASDAQ rule change, according to the people who wrote it, is about modernizing listing standards, making the exchange more competitive, removing friction that penalizes large, well-established companies that happen to have stayed private longer than usual. It's about fixing an anachronism, a rule designed for a different era of markets. And on the surface, that makes sense. A company worth $350 billion, with $6.6 billion in annual revenue, and a product that is genuinely changing global communications infrastructure, global Starlink expansion. That company probably shouldn't have to sit in index exile for 6 months, while smaller, less established companies get fast-tracked ahead of it just because they went public earlier. The rule change looks fair. The IPO looks deserved. Until you look at what actually happens when a company this size gets index eligible on day one. Until you look at what actually happens when a company this size gets index eligible on day one. Here's the number that matters. $7 trillion. That's the approximate combined AUM, assets under management, of the two largest index fund providers in the world, Vanguard and BlackRock. Together, they manage somewhere in the range of $7 trillion in S&P 500 passive index funds alone. These funds don't make decisions. They don't analyze companies. No humans involved. They don't have investment committees arguing about valuations. They have one rule: mirror the index. When a stock enters the S&P 500, every one of these funds has to buy it. They have no discretion. They have no option to wait for a better price. Their entire mandate is to match the index weight precisely. And they have to do it within a specific rebalancing window. Goldman Sachs' index rebalancing desk has modeled what happens when a company with a weight of, say, 1.5 to 2% of the S&P 500 gets added during a standard quarterly rebalance.
The estimated forced buying in the first 2 weeks is somewhere between $20 and $40 billion. Not because anyone thinks the stock is worth that price at that moment,
because the index said so. Which raises one question. If you were planning an IPO for a company worth $350 billion Latin, and you knew that index inclusion would trigger $30 billion in forced buying within 2 weeks, what would you do with that information? And who exactly would benefit most from a manufactured demand spike in the first 2 weeks of trading? Because the people who know the answer to that question are not retail investors, and they are not the index funds. They are the pre-IPO shareholders. To understand what is actually happening here, you need to understand what an index has become. Most people think of the S&P 500 as a neutral scoreboard, a measurement of the market, something that reflects reality. It's not. It stopped being that a long time ago. The S&P 500 is now the largest single demand mechanism in the history of financial markets. Every dollar that flows into a passive index fund is a dollar that must, by mandate, buy whatever the index committee has decided to include, at whatever price that stock is trading when inclusion occurs. Think of it like a pipeline that only flows in one direction. Water doesn't choose where to go. It follows the pipe. And the people who built the pipe, who decide which direction it points. which reservoirs it connects to,
which valves open and when. Those people have enormous power over where the water ends up. The NASDAQ's rule change wasn't about modernizing the exchange.
It was about shortening the distance between an IPO and the pipeline. What used to take 6 to 12 months, the waiting period before a new stock could become index eligible,
has been collapsed. And that collapse benefits exactly one type of entity. The entity that is about to list on that exchange with a valuation large enough to immediately enter the index.
There are maybe 3 companies in the world right now that qualify. One of them is the most valuable private company in history. One of them is run by the richest man on earth. And one of them is preparing to do the largest IPO in history. Those are all the same company. But here's the thing. The rule change is only half the story, because the rule change only accelerates when demand arrives. What determines how much demand arrives and at what price is a mechanism most people have never thought about. It's called float manipulation, and it is entirely legal. Here is what you will read in the financial press when SpaceX finally goes public. Massive demand for SpaceX IPO. Retail investors scramble for shares. Books oversubscribed within hours. Analysts project strong first-day trading on unprecedented interest.